there's always someone knocking on the door when I'm trying to record. So like I was saying, quantitative easing pushes markets higher. Just so you know, that was the neighbour thinking that they ordered a box of beer to the house when yesterday it was actually a toilet seat that was delivered. I found that so funny.
Hi guys, thank you so much for joining me in another video. If you're new here, be sure to hit the like button if you like what you see, and subscribe because I'm still a new channel, so I will appreciate all the support you guys can provide. So yeah, let's just get into it. So what am I talking about today? Over the next few weeks, I will post a few videos on stock market investing. I've been getting quite a few comments on how I pick stocks and how I actually invest and to get into the nitty-gritty of it. To be honest, I keep it quite simple, but I will be posting videos in the next few weeks as to what my strategies are. So I've spoken many times in other videos about how us retail folk are highly unlikely to have an edge over the market, if you know what I mean. Accepting that kind of makes us better investors in my opinion, and it's liberating both in time and in stress, because we know that it's okay to be average when you're looking at your performance and your strategies. Having said that, I do think it's quite important to understand why the market behaves in the way that it does, right? Because it helps bring perspective to all our investing, to everything that we're doing, and all the hard work that we're putting in. I think it's quite important to understand what the factors are that generally move the market, whether it's, is the bull back, has the bear eaten the bull, or has Elon sent a tweet? La-di-da-di-da. So what actually moves the market then, and what exactly influences the roller coaster that we're riding, whether we're going up or down? The first thing I want to talk about is the fact that the stock market is not the economy, okay? The stock market looks beyond the present and also to the future. When there is a correction downwards, everyone seems to run for the door, as you don't want to be caught naked when the tide goes out. I know you guys love all that. However, I do think over the long term, it does correlate with the economy in general. One thing to note is that the market does facilitate free movement of capital, and that the cost of that capital is interest rates. Boom, like you didn't know that already. Now, one of the dominant factors that determine how the stock market moves is the movement of capital, and the cost of capital is interest rates. So since 2008, and the government's using cheap money, quantitative easing, all to keep rates low, markets have been on a bit of a tear, I'm not going to lie. Just have a look at the chart. I'm going to try and put the chart up here. No, probably up here somewhere. It's more than tripled since 2008. Actually, it's closer to 370%. Imagine, just look at that graph. So while at the same time, interest rates have been at the lowest level in history, close to zero. Low interest rates make capital projects, investing in the future, and spending all so attractive, and they do help boost the economy and the stock market as well. Through my research, I came across one of the principal models used by financial modelers to evaluate projects. Stocks tend to use discounted cash flow and net present value calculations. These calculations try and illustrate the opportunity cost of capital, and lower interest rates make more of these projects viable. So it's all about the calculations, all about the mathematics and understanding that from a business perspective. In the UK, we have the MPC, which is the Monetary Policy Committee of the Bank of England. And that meets around 8 times every year to determine what the interest rate will be. I think you guys in the US have the same thing, where the Fed meets 8 times a year to set the interest rates. These meetings generally, they're supposed to be apolitical and also determine various pressures on the economy, such as unemployment, inflation and growth, and set interest rates as the medicine to cure those ailments. Can you imagine? So depending on what the situation is in the country or the market, the interest rates will adjust to kind of balance those out. So as a result, the markets tend to move in anticipation of the meetings, and where the market gets it wrong, there's a lot of action that's taken to fix the expectation. But there is just so much drama when you think about it, and the amount of puppeteers out there. Honestly, lowering interest rates is good for the market anyway. High or increasing rates are bad. So look out for it. The next time the market moves and you know what the Bank of England or the Fed have done, you'll be able to connect the two dots. It is just so obvious. The second thing I want to talk about in terms of the market moving is money supply and quantitative easing. My favorite topic. Quantitative easing is seen in the news as printing more money. Actually, that's not strictly true. We always think of money as physical, tangible, we can hold in our hand, but in reality it really isn't. We can go to the bank and withdraw our money at any time that we like. However, physical money itself is the smallest portion of the money supply, sometimes called the MO or M0, M0. So back to quantitative easing. It's not easy when you're trying to say quantitative easing so frequently while recording, honestly. Like I was saying, there's no physical money printed. That's it. That's how it is. What the central bank is doing is buying long-term treasuries in the open market with created money to increase the money supply and encourage lending and investment. As a result, when money enters the market, it drives prices up, and that has the inflationary impact. For those of you that are interested in it, it is quite fascinating, and it's one of the hot topics that I've come across in the economist circuit and conspiracy theorists who like to equate it to a giant Ponzi. But then that's what modern banking is, and you trust in law and order and you think that it's all fine, so I won't go off on a tangent there, otherwise I'll sound like Abraham Lincoln or, you know. Summary is quantitative easing that pushes the market higher, okay? Why is there always someone knocking on the door when I'm trying to record? So like I was saying, quantitative easing pushes markets higher. Just so you know, that was the neighbour thinking that they ordered a box of beer to the house when yesterday it was actually a toilet seat that was delivered. I found that so funny. Imagine your expectation is that you've got beer delivered and the reality is that you've got a toilet seat. Oh dear, it's so funny. Back into this. The third thing that I think influences how the markets move up and down is geopolitics. Guys, if you're getting bored of this, leave a comment down below and then I won't do videos like this again, because I actually find this stuff interesting and I feel like people should know it. And if you've been an economist student all of your life, then you probably know this stuff about what is this woman talking about. But for me, that's not been my foray, if you like. So I find it quite interesting. Third thing I want to talk about is geopolitics, okay? So markets generally are quite interconnected, as our globe is interconnected. I'll try and put a nice snazzy thing up here. Politics and economic policy generally can have massive trickle-down effects into other areas. A classic example is taking the US. Trump's foreign policy, public spats, and the US First agenda. All of these things have had a huge impact on international economies. We see it here in the UK. Likewise, Trump was super quick to use his fiscal tools at his disposal with tax cuts, domestic spending, which also increased the deficits as a result. Similarly, in the UK, with the uncertainty around Brexit, that has dampened our markets immensely. And the UK is down something like 10% over the last 5 years. I'll put the graph up here and you guys can see for yourself what that looks like. Then when you start comparing that with the US, just have a look at the graph, guys. The main driver for the UK's performance has been Brexit, like I was saying. The issue with these headlines is that they can vary in severity. Some are priced in over a period of time, while others can have a drastic impact on the markets themselves, as fast markets tend to adapt to the new information. So Corona is case on point, right? So when you think about the interconnected nature of our markets and the global shutdown, economic devastation at the height of the pandemic, it literally pummeled through the markets like no one had ever imagined. And then we had the interest rate cuts and the quantitative easing. See what I did there? So having said all of that, these geopolitical factors can be solid opportunities for investors and also speculators when you're factoring in decisions real time about how to invest. You have to realise that corrections can overshoot and represent potential buying opportunities. And similarly, if there's a delay between the political response to the economic event itself, it represents a good time where investors can be a little bit nimble when selecting where to put your money. So the fourth reason I want to talk about is greed. Why do the markets move? Because of greed. So this is more of a speculator's game where individual markets themselves are quite difficult to make rational sense of. So what may have started on good economic sense has created FOMO, and that's the fear of missing out, and herd speculating. So we saw examples of this, classic examples of this, when we saw Bitcoin falling from 14,750 to what was it, just above 2,700. I'll try and put a graph here. Dropping from its peak in a 6-month frenzy prior to that. Can you imagine if you, well, I know people that have invested at the top of the peak and lost all their money because they thought the peak would just carry on and there were further mountains to climb. Frenzy around that has been incredible. And this is generally called going parabolic, where speculators and investors are trying to get rich overnight. And these bubbles, unfortunately, they do burst at some point, and they burst quite quickly. But as much as they work in one direction, they can work in the opposite direction with fear. And we can again go back to the coronavirus crisis as an example, as we did in the prior one for this. So people will sell first and then ask questions later. Now, I'm not a financial advisor or anything, but I really do believe that people need to recognize a panic and avoid selling into one, and likewise recognize a frenzy and avoid buying into one. It's the worst time and it will cause financial pain, and it's just scary, really. The key is to be measured and consistent. The final point I want to talk about is economic growth, or lack of it even. We'll keep this on brief because though generally speaking the market does react quite quickly based on how the economy is doing, and the economy is the reality and the market is expected reality. If we're seeing growth in the economy now, then the facilitators, which are the businesses that support the economy, will also be expected to do well. So that's why there's so much interest in numbers like GDP growth, wage growth, because these are the numbers that are used to ascertain the current state of the economy itself. So the market can figure out what the future of these facilitators will be by reviewing these numbers. Just looking at the coronavirus pandemic, you'll see that every single point on the 1 to 5 list I've talked about plays out in the market at some point or another, and some are still playing out, which makes the market such an exciting conversation point. Everyone is interested in it, whether you're Bob down the corner shop or you're a city high flyer or whatever. Everyone's interested in how the markets are doing because it's all impacting how we are doing as individuals as well. I'll do what I always do: grab my bowl of popcorn, stay consistent, invest consistently for the long term, and just watch from the sidelines, guys. It's such a good show out there, because if things did go belly up, we would all be zombies anyway. But by the way, do leave me a comment down below what you think of this video. Hit that like button because it helps with the algorithm, and subscribe if you haven't already because I'm a new channel. But until next time, I'm out. Cheers guys, bye.